Good afternoon, cadets, visitors, curious. If you're curious, you've come to the right place. My name is Sam Allen. I'm a professor of economics here at VMI. I'm also this year's president of the Virginia Association of Economists, and it's a real privilege for me to introduce today's speaker, President Bill Dudley. The title of today's lecture is the Sandridge Lecture, and it's named in honor of one of the 22 economists who started the Virginia Association of Economists. And past speakers have included a Nobel laureate, as well as Ben Bernanke, and a number of other economic luminaries. They've gone on to do great things, and tonight's speaker is no exception. President Dudley is the president of the New York Fed. He has extensive experience on Wall Street as partner and managing director of Goldman Sachs and Company. He also earned his PhD from UC Berkeley, and if I'm not mistaken, he wrote his dissertation in microeconomics. So shifted gears a little bit to do major policy work in macroeconomics. And since it's economics, I'll try to be efficient and not draw it out, but please join me in welcoming the president of the New York Federal Reserve Bank, Bill Dudley.
I'm very impressed, knowing that I was really a microeconomist by training, not a macroeconomist. I was very lucky, though. The professor I worked with at Berkeley, UC Berkeley, for 5 years, who became a very good friend of mine, was a macroeconomist. His name was Jim Pierce, and he's the person who got me interested in going to work for the Federal Reserve when I graduated from Berkeley. I took a little detour to JP Morgan and Goldman Sachs for the next 23 years, but I finally got back to the central bank. And my timing was either really good or really bad, depending on your perspective. I joined the New York Fed in January of 2007, so 6 months of calm, and then things got very, very interesting. It's a great pleasure to have the opportunity to speak here today as part of the Virginia Association of Economists meeting at the Virginia Military Institute and Washington and Lee University. This is a very appropriate setting for the topic I'll be addressing, the role of the Federal Reserve as the central bank of the United States. When the Federal Reserve Act was enacted in 1913, H. Parker Willis, who had been a professor at Washington and Lee University, played a critical role, and he worked closely with Representative Carter Glass of Virginia from Lynchburg, just down the road, in crafting the legislative proposal that established the Federal Reserve. And Willis went on to become the first secretary of the Federal Reserve Board in 1914. Now, of course, I'm tackling this subject today not just because H. Parker Willis was a professor here in Lexington. Instead, I'm addressing this issue because of the ongoing debate about the role of the Federal Reserve and its structure and governance. My purpose today is to demystify the nation's central bank and to respond to some of the critiques that the Federal Reserve continues to face. I think this is necessary because there is a risk that the Federal Reserve could be changed in ways that might impair our ability to achieve our primary objectives, namely full employment and price stability. As always, what I have to say today reflects my own views and not necessarily those of the Federal Open Market Committee or of the Federal Reserve System. Now, the current debate surrounding the nation's central bank is not new, but rather dates back to our nation's independence from Great Britain. The notion of a central bank in the United States has nearly always been controversial in concept, design, and practice. So much so that the charters of the first 2 U.S. central banks, the first and second banks of the United States, were allowed to lapse, and the banks went out of existence. The United States, in contrast to many of our European counterparts, had no central bank at all from 1836 to 1913. During this period, the economy was prone to financial panics. The rapid development of the 19th century American economy, including the westward expansion made possible by the railroads, outstripped the ability of the private banking system to satisfy the nation's needs for an elastic currency and a stable supply of credit. Ultimately, the panic of 1907, in which J.P. Morgan, who was the leading financier of the day, played an outside role in responding to the crisis, was the catalyst that turned the tide back in favor of establishing a central bank. The debate preceding the passage of the Federal Reserve Act in 1913 was protracted and intense. Early drafts of the reform proposals were careful not even to mention the term central bank. The 75-year scars from the second bank's failed reauthorization battle had still not fully healed. Although there was a strong recognition that the country needed a central bank to forestall and mitigate financial panics, there was considerable disagreement about how it should be structured. Important considerations included what role should be played by private bankers versus government officials, how centralized the new bank should be, and what should be the extent of its powers. During this period, the U.S. economy was susceptible to financial panics. Lacking a central bank, the country had no reliable lender of last resort that could provide currency and credit on demand against high-quality assets. Banks had to self-insure against bank runs by holding a high fraction of their deposits as cash and by entering into private liquidity arrangements with other banks. Self-insurance was not only expensive relative to the cost of a public backstop provided by a central bank, but it's also limited in its effectiveness. When the business cycle turned down and financial stress intensified, bank runs often ensued as bank customers rushed to convert their deposits into cash. Without a true lender of last resort, cash that banks individually and collectively kept in reserve often proved inadequate to meet this demand. At that point, a bank under duress had two choices, either to close its door or to quickly sell assets. Of course, either action worked to intensify the panic and to increase the stress on the economy. The Federal Reserve was established so that there would be a lender of last resort that could lend against high-quality collateral and provide a reliable and elastic currency. The knowledge that such a lender of last resort existed reduced considerably the incentives for depositors to race to their bank to make withdrawals at the first sign of trouble. At that time, the provision of an elastic currency was especially important because the agricultural sector represented a significant proportion of the overall U.S. economy. As a result, the demand for credit increased significantly every fall when farmers incurred the costs associated with harvesting their crops. Prior to the establishment of the Fed, accommodating this seasonal demand necessitated an outflow of currency and credit from the major financial markets such as New York and Chicago, and that put upward pressure on interest rates. With its ability to provide an elastic currency, the Federal Reserve would be able to dampen such seasonal swings in interest rates. Now, at its inception, the Federal Reserve differed from central banks in Europe in that it was decentralized. The design reflected long-standing concerns in our country about the concentration of power in a single authority. These concerns are reflected in the structure of the U.S. government established by the Constitution in 1787. Similarly, the design adopted for the central bank in 1913 was also federated with 12 independent reserve banks, each with their own capital and board of directors, overseen by a seven-member Federal Reserve Board in Washington, with the Secretary of Treasury serving as the chair of the board. This decentralized structure allayed the prevailing fears of concentrating power in either New York or Washington, and especially within the banking community of ceding too much power to the federal government. Paul Warburg was an American banker who had emigrated to the United States from Europe. He was deeply involved in the debate about the appropriate structure of the central bank. He described the concern as follows, and I quote, "The view was generally held that centralization of banking would inevitably result in one of two alternatives, either complete governmental control, which meant politics and banking, or control by Wall Street, which meant banking and politics." Importantly, the Federal Reserve was designed to have budgetary independence for the federal government. The system funds itself through its business operations, not through congressional appropriations. This formed an important foundation in ensuring that the conduct of monetary policy would be independent from political influence. A wide range of research has shown that central banks achieve better outcomes with respect to employment and inflation when they are insulated from short-term political pressures in their conduct of monetary policy. Now, after its creation, the Federal Reserve was soon tested, first by the Depression of 1920-21, and then, of course, by the Great Depression. The searing experience of the Great Depression, including the 1933 banking holiday, where all the banks in the country were closed, and thousands of bank failures, revealed significant shortcomings. This led to the Banking Act of 1935, which made two important changes: establishing a federal deposit insurance system and making the Federal Reserve System more centralized. The Great Depression made it clear that having a lender of last resort was not sufficient for preventing bank runs. Deposit insurance, which had been debated but not adopted during the drafting of the Federal Reserve Act, was instituted with the creation of the Federal Deposit Insurance Corporation. A second lesson from the Great Depression was that monetary policy would be more effective if it was coordinated at the national level rather than just conducted individually by each of the 12 reserve banks. To accomplish this, the Banking Act replaced the Federal Reserve Board with the Board of Governors of the Federal Reserve System and established the Federal Open Market Committee to oversee the conduct of monetary policies. The governors in Washington were made dominant because they were given the majority of votes on the FOMC. Over time, the role of the executive branch in the U.S. Treasury was reduced. Beginning in 1936, the Secretary of Treasury no longer served on the FOMC. The Federal Reserve Board moved to its own building in 1937, and the Federal Reserve gained independence in the setting of monetary policy with the Treasury-Federal Reserve Accord in 1951. Now, a century following the panic of 1907, another financial crisis led to the Great Recession. As was the case following the Great Depression, weaknesses exposed by the crisis led to further changes at the Federal Reserve. Some of these changes were legislated, while others were initiated by the Fed itself. Before discussing the lessons learned from the financial crisis and the changes that ensued, I think it's important to recount the Fed's efforts to support the U.S. economy during this recent period of severe economic and financial stress. As you may recall, the Federal Reserve responded to the financial crisis in two ways. First, it intervened to prevent the failure of several systemically important institutions, including some firms that the Fed did not supervise, namely Bear Stearns and AIG. Second, established a number of special liquidity facilities to ensure that domestic banks, securities dealers, commercial paper issuers, money market mutual funds, and foreign banks all had sufficient access to dollar liquidity so they could sustain their lending and investment activities and thereby continue to supply credit to households and businesses. I strongly believe that these interventions were necessary to prevent a systemic collapse of the global financial system. If such a collapse had occurred, I am convinced that the consequences would have been a global depression. If the Federal Reserve hadn't done everything in its authority to prevent a collapse, I think we would have been derelict in our duty to the country. Let me be clear, the interventions by the Fed during the crisis were designed to safeguard the economy for the benefit of all Americans while protecting the taxpayer. I'm proud of our record on both accounts. In the end, the Federal Reserve's extraordinary interventions achieved their intended purposes to support economic activity, and incidentally, taxpayers were compensated for the risk undertaken in these interventions. Total profits from the Fed's extraordinary interventions were more than $30 billion. One important condition for lending in these programs was that loans had to be secured to the satisfaction of the Federal Reserve Bank extending the loan. Despite the degree of dislocation in the financial system that we saw at the time and the severity of the Great Recession, there were no losses for any of the Fed's programs. At the same time, I do also agree with those critics who argue that there was something fundamentally unfair about the disparity in treatment between the few large financial institutions that were saved versus the millions of individuals who lost their jobs or homes. Now, my response to this is not particularly satisfying. Recessions inflict considerable pain on innocent bystanders in the economy, and depressions greatly compound this pain. Given the Federal Reserve's role and authority, what we knew at the time, and the powers and tools that were available to us, I think we made good choices. If the large systemic banking organizations had failed, the hardships inflicted on households and businesses would have been far worse. From my perspective, I believe that any critique of the Fed and the other agencies should be focused more on the regulatory and supervisory shortcomings, some of which I admit were ours, that created the economic and financial market circumstances in which the Fed's extraordinary interventions proved necessary. This leads me back to some of those lessons learned and the changes that have resulted. The crisis showed that the regulatory community did not fully grasp the vulnerability of the financial system. In particular, critical financial institutions were not resilient enough to cope with large-scale disruptions without assistance, and problems in one institution quickly spread to others. In response, the Federal Reserve has made significant changes in how we regulate and supervise financial institutions. We've raised capital and liquidity requirements. We put banks through annual stress tests. We established a committee called the Large Institution Supervision Coordination Committee, which enabled us to value the largest firms collectively and relative to one another. We set up an Office of Financial Stability to enable us to look at the financial system more holistically. Financial stability now receives the attention it deserves. For example, there are now regular briefings and discussions on financial stability at FOMC meetings. As discussed earlier, the Federal Reserve has the responsibility to be the lender of last resort. In normal times, this occurs through the discount window lending to depository institutions. During the financial crisis, the Fed used Section 13.3 of the Federal Reserve Act, which enabled the Fed to make extensions of credit in, quote, unusual and exigent, unquote, circumstances to individuals, partnerships, and corporations. The extraordinary interventions that were undertaken using our emergency powers under Section 13.3 of the Federal Reserve Act were warranted and were within our authority. However, I suspect that the scale and scope of these interventions went considerably further than envisioned by the public and Congress prior to the financial crisis. In response, Congress narrowed the scope of Section 13.3 with the Dodd-Frank Act. In particular, the Dodd-Frank Act limits the Federal Reserve's authority to extend credit through facilities with broad-based eligibility and constrains the Federal Reserve's authority to extend credit to a single company. The Dodd-Frank Act also modified the governance that would apply to any future intervention in an effort to increase public accountability. In addition, the Dodd-Frank Act addressed the broader issue exposed by the crisis, that some large financial institutions had become too big to fail. To end too big to fail, Title II of the Dodd-Frank Act established a process to ensure that any financial firm could be resolved without threatening the viability of the financial system and without putting taxpayer funds at risk. In addition, financial intermediaries designated as systemically important by the Financial Stability Oversight Council are subject to tougher prudential standards and enhanced supervision by the Federal Reserve. The intent behind these measures is to reduce the likelihood of failure of a large financial firm and the consequence of such a failure for the financial system should a failure occur. The Dodd-Frank Act left intact the decentralized structure of the original federated Federal Reserve System, the 12 reserve banks, and the Board of Governors in Washington. Each reserve bank continues to operate as a separately capitalized corporation with its own board of directors. But to limit the role of bankers on the Federal Reserve Bank boards, the Dodd-Frank Act prohibited the bankers on each board from participating in the selection of its reserve bank president. Even prior to the Dodd-Frank Act, it's important to emphasize that the directors played no significant role in setting policy. Instead, the role of the directors is to advise the Reserve Bank president about economic, community, and business developments in their district and to ensure that the bank is well-governed and well-managed institution. And although member banks hold capital in the Federal Reserve and receive a dividend set by law against this capital, member banks do not influence the Federal Reserve's monetary policy and regulatory policy decisions, how that policy is implemented, or the supervisory oversight of banks. The Dodd-Frank Act also addressed the need for enhanced transparency by establishing disclosure requirements for participation in Federal Reserve facilities. In terms of transparency, I do think it's a fair critique that in the past, the Federal Reserve has not always been sufficiently transparent. For example, prior to 1994, we typically didn't even announce changes that were being implemented in the conduct of monetary policy. Market participants, and I did this when I was at Goldman Sachs, had to infer what we were doing from our daily open market operations and where the federal funds rate was trading. During the crisis, I also believe we could have done more to explain the motivations for our extraordinary interventions. While at times the motivations and objectives might have been obvious to us, they weren't always as readily apparent to Congress or to the public. I think this created uncertainty about what we were trying to accomplish and made it more difficult for outside observers to assess the appropriateness of our actions and our motives. Now, today the situation is quite different. We've made significant enhancements with respect to transparency. After each meeting, the FOMC issues a statement that sets the current target range for the federal funds rate and explains its monetary policy decision. 4 times a year, the chair of the Federal Reserve Board holds a press conference explaining the decision, and the FOMC releases its Summary of Economic Projections, or SEP. The SEP provides the FOMC participants forecasts for key economic variables and the federal funds rate that the participants expect to see over the next few years. In addition, FOMC participants give numerous speeches explaining their views on monetary policy and other issues, and the chair regularly testifies about monetary policy and the Federal Reserve's other activities before Congress. Overall, I've found this move towards greater transparency has held us in good stead. Now, nearly 6 years since the enactment of the Dodd-Frank Act, there still remains considerable debate about whether changes to the role and structure of the Federal Reserve System are warranted. Some of the issues being debated include how much discretion the Federal Reserve should have in the conduct of monetary policy, whether the Federal Reserve is sufficiently transparent in how it operates, and the role of the New York Fed. I would caution that any further changes to the Federal Reserve System should be grounded on what we've learned from the crisis and based on the needs of our evolving economy. Changes should be undertaken if they would make the Federal Reserve more effective in its mission. In contrast, changes based on an emotional, unreasoned response in reaction to the pain associated with the financial crisis and the Great Recession would likely be counterproductive. Now, some argue that the Federal Reserve has too much discretion in its implementation of monetary policy, and consequently, they'd have the Fed stick to a formal rule in the conduct of monetary policy. This is a poor idea because adherence to a simple rule would undoubtedly lead to significant policy errors. The world is simply too complex to put monetary policy on autopilot. Concerns over the FOMC's degree of discretion in monetary policy likely reflect in part the innovations in monetary policy that were enacted in recent years that added accommodation at a time when short-term interest rates were stuck very close to the zero lower bound. In particular, the Federal Reserve's balance sheet grew substantially as the Federal Reserve enacted a series of large-scale asset purchase programs designed to support economic activity. With respect to the argument that these programs have distorted financial markets, I would simply respond that monetary policy always affects financial markets and financial asset valuations. The expected path of the federal funds rate is an important factor influencing the level of bond yields, and the level of bond yields and bond term premium have implications for the valuations of other financial assets, such as equities, and they also influence the foreign exchange value of the dollar. Of course, the impact of monetary policy may have been greater this time, but this is mainly because more monetary policy stimulus has been required during the current economic cycle in order to push the U.S. economy back towards the Fed's dual mandate objectives. I believe if the Fed had not responded as forcefully as we have, the recovery would have been slower, the unemployment rate would have been higher, and there would have been a greater risk of deflation. While it's much too soon to claim success, the U.S. economy today is in relatively good shape compared to most other countries. The economic expansion is in its 7th year, and we have made considerable progress relative to our employment and inflation objectives. Also, the tools that we designed to control monetary policy, even with a very large balance sheet, have been shown to be effective. In December, when we raised the target range for the federal funds rate from 25 to 50 basis points, the first Fed increase in many years, we also raised the interest rate we pay on bank reserves to 50 basis points and the rate we pay on our overnight reverse repo facility to 25 basis points. Not only have these new tools been effective in moving the federal funds rate up into the middle of its new target range, but the entire complex of money market rates has moved up as well. Also, the fears expressed by some that the Federal Reserve's very large balance sheet would lead to runaway inflation have proven to be unwarranted. Now that we have demonstrated that we have monetary control, even with a very large balance sheet, I would hope that this issue has been put to rest. As I noted earlier, I am a committed advocate for enhanced transparency, and we're always looking for ways to improve. But of course, there are limits. One could argue, for example, that a live broadcast of a Federal Open Market Committee meeting would be more transparent. But I think such a broadcast would do considerable harm by constraining candor and debate over the appropriate monetary policy decision. I believe it would lead to less informed decisions and consequently poor execution of our monetary policy responsibilities. Similarly, disclosing in real time who is borrowing from the Federal Reserve's discount window would likely undercut the effectiveness of the window. Banks might be reluctant to borrow if this were immediately made public, because such borrowing might be construed in the market as a sign of weakness. Stigmatizing discount window use by banks would make this tool less effective as a lender of last resort backstop for bank liquidity needs. Now, while there obviously is a point of diminishing returns in terms of increased transparency, I think it's reasonable to evaluate what further steps the Federal Reserve could make in this direction, judging whether additional steps would enhance versus diminish the effectiveness of our tools and policies and our ability to achieve our objectives. With regard to the Federal Reserve Bank of New York, which I have the responsibility of leading, I observe that the New York Fed, like the other 11 reserve banks, serves to support the overall mission of the Federal Reserve System. By virtue of its location, the New York Fed has a unique responsibility on behalf of the system, namely to serve as the operational arm of the Federal Open Market Committee with respect to the implementation of monetary policy. This separation of the policy arm and the operational arm of monetary policy in two distinct institutions is a very unusual setup among central banks. There are good reasons why these important functions are assigned to the New York Fed. Monetary policy works by affecting financial market conditions in order to promote the economic outcomes consistent with the Fed's dual mandate objectives. As such, effective and efficient monetary policy execution requires a practical and thorough understanding of the broad range of financial markets through which monetary policy operates. New York City is the nation's principal financial center. By locating the duties related to the execution of monetary policy at the New York Fed, the system gains a number of benefits. These include the New York Fed's ability to develop expertise in and understanding of the broad spectrum of financial markets and institutions that reside in New York, and its access to a deep pool of specialized financial talent in the place where it's most concentrated. The New York Fed's institutional knowledge and experience in financial markets and its related disciplines are a critical input at all times, but never more so than during periods of distress. This was evidenced during the financial crisis when the New York Fed's unique insights and expertise helped the Federal Reserve respond quickly and effectively to unfolding events. The authors who crafted the Federal Reserve Act, such as Carter Glass, assisted by H. Parker Willis, deliberately created a central bank structure that fits the U.S. political system with a series of important checks and balances between Washington and the rest of the country, between Washington and New York, and with respect to the role of the federal government versus the private sector. These checks and balances exist to ensure that the central bank acts in the broadest interest of the nation and is appropriately insulated from short-term political pressures and considerations. In this construction, New York does have a special role, but one that stems from where New York sits. In New York City, the nation's most important financial center. The Federal Reserve exists to serve Main Street, not Wall Street. The dual mandate objectives established by Congress, full employment and price stability, are clear on this point. There is no mention of Wall Street. At the same time, it is broadly recognized that without a well-functioning financial system, it would be difficult, if not impossible, for the Federal Reserve to achieve these objectives. The Federal Reserve has evolved considerably since its inception in 1913, and this evolution has been informed by the lessons from past financial crises. The goal has been to make the Federal Reserve even more effective in carrying out its mission. This process of learning from experience is as critical for institutions as it is for individuals. To paraphrase Winston Churchill, people always make mistakes, but only wise ones learn from their mistakes. Thank you for your kind attention. I'd be happy to take a few questions. Well, my good friend and chair of the Fed, Janet Yellen, gave a speech in New York 2 days ago, and I was the chair of the forum, the Economic Club in New York, and I got to introduce Chair Yellen, and I agree with everything she said. I think that to paraphrase I think her message, and it's my message as well. If the economy stays on its current trajectory, growing above trend, gradually putting greater pressure on the nation's resources, the labor market gradually tightening, the unemployment drifting back up towards 2%, then I think we're going to continue this gradual normalization of monetary policy. But we're proceeding, quite cautiously because, one, the economy is not growing that fast, just growing a little bit above trend. And number two, there's a lot of uncertainty in the rest of the world that could have consequences for us. And three, the risk of error are somewhat asymmetric when you're very, very close to zero interest rates. If you tighten monetary policy and it turns out that the subsequent news doesn't support that, there's not a lot of room to turn around and make monetary policy more stimulative to support the economy. Conversely, if the economy turns out stronger than expected, well, it's pretty easy to catch up by raising interest rates. So the risk management considerations also weigh on being quite careful and gradual in the normalization of monetary policy. So the FOMC a few weeks ago published the summary of economic projections. This is a forecast. It's not a commitment. It's not binding in any way. It depends on how the economy actually evolves, both in terms of data, financial markets, developments abroad. All those things affect what the Fed will ultimately do over the coming months and years. But these projections, which are based on people's expectations of what they thought was likely, showed that the median FOMC participant expected 2 more rate increases in 2016 and further rate increases in 2017 and 2018. And we should hope that that occurs, because if it does occur, it means that we're actually making progress towards our objectives. Other questions? With that, okay.
You mentioned some of the international uncertainties of a very large demand for high denomination Federal Reserve notes outside of the United States. To what extent do you think the demand for U.S. currency as a source of security in the world is affecting traditional relations between the monetary aggregates and the GDP and price?
Well, for many, many, many years, the U.S. dollar currency has been an attractive store of value in part because the Federal Reserve has been doing a pretty good job in terms of keeping inflation close to our 2% objective, but also because the U.S. economy is pretty stable. The United States is a very powerful country in the world, and so it's store of value not just in the U.S. but around many, many other parts. People estimate about 2/3 of U.S. currency is held abroad. I don't think that anything dramatic has changed in recent years, to dramatically change the demand for dollars abroad. But clearly, that demand can go up and down depending on what's happening in the rest of the world. And we probably need to look through that a little bit in terms of our assessment of how monetary policy is working. Back in the early 1980s, when Paul Volcker became chair of the Federal Reserve, there was a greater focus on the monetary aggregates. But it turned out that the relation of the monetary aggregates to real economic activity in the U.S. turned out to be pretty unstable. And so subsequent to that period, the Federal Reserve has really shifted back and focused more on interest rates. So I think, the monetary aggregates, it's another input to evaluate the stance of monetary policy. But in a world of very large capital markets, fluctuating demand for currency, both in the United States and abroad, probably not that reliable in terms of telling you much about the stance of monetary policy, and so not very front and center in terms of how we think about the stance of monetary policy in the U.S. currently. Other questions? Yes.
If you had any ideas on the growing partnership between sort of like all the central banks because of the ongoing commodity crunch and sort of migrant crisis, and how that could continue with a race to the bottom?
Well, first of all, this notion that all of a sudden the central banks are getting along and they didn't get along before, I think that's not right. I mean, every year I go to Basel, Switzerland, where the Bank of International Settlements sits at least 5 times a year, sometimes more. And those meetings are about are all the central bankers around the world to get together to talk about the issues of the day in terms of the global economy, in terms of financial regulation, in terms of the structure of financial markets. So for many, many, many years, there's been this fraternity of central bankers that I think has actually made this a very a great group in terms of trust, communication, exchange of perspectives. So I don't think there's anything new here that's happened recently. The recent G20 meeting has gotten a lot of speculation that there's some sort of grand plan that's being coordinated among central banks around the world and foreign governments. I wasn't at the G20 meeting, so I can't report on what occurred there. But just to say that cooperation is always very, very important, because we know that what we do in the U.S. does affect foreign countries and economies, and what happens abroad then ripples back to us. So even though our mandate is very much domestic, maximize U.S. employment and achieve U.S. price stability, we certainly recognize that what happens in the rest of the world can affect that. One thing that we've been really very, I think, attentive to is how we communicate what we're doing and why we're doing it. Because we find that if we can communicate well, that can make the transition from one monetary policy to another a lot less bumpy. Example where it didn't go particularly well was a couple years ago when Chairman Bernanke was talking about how we were at some point going to reduce the rate of asset purchases. And a lot of people in the world, this unnerved them because they thought this meant that the Federal Reserve was also going to very quickly move to tightening monetary policy. We didn't communicate that as well as I think we would have liked to in retrospect. And so there was a pretty big reaction in financial markets, both in the United States and abroad. And that was unfortunate because that actually made it more difficult to achieve our monetary policy objectives. So communication, both here, abroad, with our foreign central bank colleagues, all very, very, very important in terms of making monetary policy in the U.S. work as well as it possibly can. Other questions?
Would you care to comment on the use of negative interest rates by other central banks? Share your thoughts.
Well, I mean, I think from the U.S. perspective, this is not something that's on the table. I mean, we're thinking about the next move of interest rates is, we think it's highly likely to be up, not down. And there's a lot of tools. Let's say I'm wrong, and let's say the U.S. economy gets hit with a really negative shock, and we have to reverse course. There's a whole bunch of things that we would think about doing long before we even begin to contemplate negative interest rates. And speaking for myself, it's not clear to me, even if we exhausted all those other tools, which I think it would take a lot to exhaust, it's not even clear to me at that point that interest rates, negative interest rates, the benefits would exceed the cost. If you look back a few years ago when we were quite a bit further from our objectives and the economy was also quite sluggish, we contemplated the issue, should we move to even lower interest rates? Should we push short-term interest rates into negative territory? And we decided against it because we decided that at that time that the benefits were less than the cost. And so I think you should take some signal from that decision that was made a few years ago, recognizing, of course, that times change, circumstances change, the environment changed. So I'm not ruling it out, forever. But I think that's not something that people want to speculate about this for some reason. I'm sort of, I'm not sure I understand why this is so interesting to people, because to me it's really, really, it's not something I spend a lot of time thinking about, except when I get asked questions about it. Other questions? Yes.
You mentioned transparency at the Fed and undue political influence. And I'm curious in your thoughts about, you hear congressmen and senators and so forth talk about the secretive Fed, and they should be audited more, and they shouldn't be so independent, and so forth and so on. So I'd appreciate your thoughts on that subject.
Well, clearly, when we say we're independent, I want to define that pretty narrowly. Independent in the conduct of monetary policy. And why independent in the conduct of monetary policy? We want to have independence in the conduct of monetary policy because you don't want to have politicians worried about the election cycle make monetary policy sort of, pump up the economy just before the election and then have to slam on the brakes after the election. That would not lead to a good monetary policy. So you want to have some distance between the central bank in setting monetary policy from the political process, because presumably you want the central bank to take a longer view than what's going to happen in the upcoming elections in November. And the academic literature, as I mentioned in my speech, really bears this out. Countries that have have the ability to insulate the central bank from politics in the conduct of monetary policy have better outcomes with respect to employment and inflation than those who don't, where they don't have that insulation. Now, that independence does not extend to the Fed. We don't just get to do whatever we want. The Federal Reserve is very much a creature of Congress. The Federal Reserve sets the rules of the road for what the central bank's powers are and how we can operate. And the powers are not as broad as people might think. During the financial crisis, I got many suggestions about how we should do things. And a lot of times I had to point out to people that, I'm sorry, but we can't do that. The Federal Reserve does not allow us to buy this type of asset or engage in this type of activity. And so it's completely appropriate for Congress to define, what the scope and responsibilities of the Federal Reserve power, and it's perfectly appropriate for Congress to have us explain why we're conducting the monetary policy that we're conducting. So I think we have a good balance here where there's independence in terms of decision-making and what's the appropriate monetary policy, but then the Federal Reserve has to go to Congress and explain itself in terms of why it chose that particular monetary policy, or in a financial crisis, why the Fed intervened in the way it did, consistent with the powers that the Congress has given to the Fed under the Federal Reserve Act. Well, we are already audited. This idea that we're not audited, our financials are audited. I mean, the New York Fed, we have so many different people looking at our operations. The Board of Governors, we have an internal auditor, the Board of Directors has an audit and risk committee. So there's lots of scrutiny in terms of how we conduct our business. The so-called audit the Fed bill is a little different. It's really about the Federal Reserve coming after every FOMC meeting and explaining precisely why they did what they did. And there are versions of the bill that would actually say the Federal Reserve has to follow a particular rule in terms of its conduct to monetary policy. And if it diverges from that rule, it has to explain why it diverged from that rule. Well, I think this is a really bad starting point to sort of say the rule is the thing that's your default, and any divergences from the rule you have to explain. If we had followed a rule as we were going into the financial crisis, I think it would have been really a bad outcome because we would have been really, really late. We would have waited for the unemployment rate to rise a lot. We would have waited for inflation rate to fall, and only then would we start to make monetary policy as easy as it needed to be in real time. Most rules are not forward-looking. They just take the world as it is today. And monetary policy requires judgment, and I think you really want to be able to look forward and anticipate how the world's going to evolve in the future. Another problem with the rule is the structure of the economy changes. The equilibrium interest rate, consistent with sort of growth at the economy's potential, moves up and down over time. So, if you use a simple rule that has a single interest rate in it that says this is the interest rate you have to use as your calibration of monetary policy, you're probably going to make some pretty big mistakes when the equilibrium interest rate moves up or down as it has over the last few years. We're pretty confident right now, for example, that the inflation-adjusted short-term interest rate associated with sort of a neutral monetary policy is about 0%. Historically, it's been about 2%. So if you're using a rule that had 2% right now, monetary policy would be way, way too tight. So rule is not something that I favor. I think judgment, rules are good, rules are interesting, tool as a guide to see what it shows. But at the end of the day, I think it's really important that we actually use judgment. How many people here would be comfortable with flying a plane without any pilots on board? I like the fact that there are pilots on the plane. Yes?
There are a lot of young economists in the room. What's a lesson that you took from your principles of macroeconomics?
My principles of macro or micro? Macro. Oh, macro. I don't remember my principles of macro class very well. The thing that's interesting about principles of macro, is there are some pretty important things that were left out, and I think economists are really wrestling with that today. If you read a macroeconomics textbook, there's really very little role of the financial sector, and what we saw in the financial crisis is that the financial sector plays a really important role, especially when things go wrong in the financial sector. So one of the big challenges for academic economists today is to figure out how to build in a financial sector that seems to be descriptive of how the financial sector works in practice, but that it's also one that you can actually use to think about the economy on a conceptual basis. And this is really the big challenge for macroeconomists, I think, looking for, from 5 years ago and looking forward. And I'm hoping in my lifetime that we actually see a macroeconomy model that has a robust financial sector that also admits some of the animal spirits and changes in confidence that can really have really pretty significant consequences for the economy, like we saw in 2007, 8, and 2009. I wrote two speeches back in that period, and they were titled Things I Never Expected to See during my lifetime. There are a lot of things that happened that no one really would have built into a model at the time because they just didn't realize that the trust between lenders and investors could break down to the type of degree that we saw in the financial crisis and really make the financial system not functional. And what we saw, of course, in the financial crisis is without a functional financial system, the real economy, the ability of households and business to carry on in terms of their daily activity becomes impaired as well. So having a robust and resilient financial system is really, really important for the economy to operate. And that's the thing we really need to build into macroeconomics in a better way, I think. Yes?
You just said that the Fed should avoid simple rules. It seems to me that the 2% inflation target becomes very close. And secondly, question is, right now inflation is running at low rates because low energy prices, low import prices. It would really help purchasing power
Well, that depends on what happens to wages. We don't want inflation to go to 2% and wages to stay where they are today. I mean, we would hope that the reason why inflation is moving to 2% is that wages are what's driving that inflation up. So yeah, I think you're making a really important point, though, that the Federal Reserve doesn't always communicate properly. We don't want higher inflation and the same income, same nominal incomes and the same nominal wages. We want to have higher wages and higher inflation. And the reason for that is if inflation's really low, I mean really low, 0%, 1%, the labor market doesn't function very well because businesses are really reluctant to cut people's nominal wages. And so having a little bit of inflation means that you can have a little bit more flexibility in the labor market, and the labor market can actually do a better job allocating resources throughout the economy. The other reason why you want to have a little bit of inflation is because you want to actually have the scope to reduce interest rates to stimulate the economy if the economy gets hit with a negative shock. If you don't have any inflation, let's say the inflation target were 0 rather than 2%. That would mean the funds rate, even in good periods of time, would be 1 to 2%. If the economy was hit with a shock, what could you do? You could only push the federal funds rate down by 1 to 2%. If you have 2% inflation, you can actually push, the funds rate's going to be 3 to 4%, so there's a little bit more room to make monetary policy accommodative if you're hit with a negative shock. And the last reason to have a little bit of inflation is, I think most economists think that inflation is probably a bit mismeasured. You think of, I think, one of the big conundrums right now is why is productivity growth so weak? It's been measured over the last 4 or 5 years at only running about 0.5% per year. And then people look around and they say, well, gee, there's a lot of really cool things that are happening. I mean, like your ability to look up on your iPhone or your Android phone, pretty much any fact today that you want to debate on Wikipedia in 5 seconds, and you don't have to really even pay Wikipedia, you can make a donation. That has a lot of value, but that's not really sort of captured in output very well in terms of how we measure output in the United States. So 2% inflation is a judgment call on the part of central banks around the world. They think it provides a little bit more, they think it's enough inflation to provide some flexibility to monetary policy, to make monetary policy easy. So enough inflation to make the labor market work as efficiently as possible. But it's not so much that it starts to really distort people's investment and spending decisions because the price level is moving very, very slowly upward. People can debate it. I mean, 2%, it doesn't have to be 2%. 2% is really the standard that we've arrived at in the U.S., and we think it's working pretty well. Obviously, to move off 2% after we spent many, many, many years convincing people that 2% is our objective and getting inflation expectations really anchored close to 2%, I think there would be a big cost if we were to move off that 2% objective. So I'm not in favor of moving away from that 2% objective. Okay, last question, please. Yes, we do. I think the Federal Reserve Bank of New York is the largest gold depository in the world. I'm not even sure how to answer that question. The gold, we hold a lot of gold at the New York Fed, and it's almost all gold of foreign countries. A lot of the gold got there during the 2 world wars where people wanted a safe place for their gold. And the reality is if countries want their gold back, we're absolutely happy to send it to them. So if there's any delay in the gold going back to Germany, it's because something on their end, I would think. And I'm not aware of any problems in getting their gold back. They've asked for their gold back, not just from the U.S., but from a few other countries. There was some, I think, political issue in Germany about whether the gold was really there. And so they sort of like someone who wants to make sure that the money that they have under the mattress is still there, wanted to check on their gold. And we're absolutely, completely comfortable with that. Any country that doesn't want to hold its gold at the New York Federal Reserve, we're very happy to make arrangements for that country to take their gold home. We have absolutely no skin in the game at all. It's completely up to those countries where they want to hold their gold.
Have you made gold swaps with other central banks or governments?
I can't comment on individual customer kind of transactions. I want to ask for one more question because I don't want to end on that question. We had one in the back. I absolutely agree with the premise of your question that we absolutely need to resolve too big to fail. I mean, you saw that, you know, too big to fail, it's not acceptable. It's just not acceptable because it sort of warps justice, right? Why do certain people, just by the benefit of their size, get treated differently than people that are smaller? That doesn't make any sense. So where do I think we are on too big to fail? Well, I think we've made a lot of progress. There's sort of two aspects of too big to fail that are important. Number one, the probability of a firm failing. And two, if it does fail, what happens to the rest of the financial system? I think we made tremendous amount of progress on reducing the probability of failure of a large systemically important firms. Why? Higher capital requirements, higher liquidity requirements, stress testing, limits on the ability of firms' ability to pay out their capital through dividends and share repurchases, horizontal evaluation of the firms versus one another. All these things I think have reduced the probability of failure of these firms a lot. But that's not sufficient. You also have to, I mean, there are going to be future financial crises. Of that I'm absolutely confident. So if despite all our best efforts, capital, liquidity, stress testing, a large financial institution gets in trouble, you also want to make it so that if it does get in trouble and fails, you can let it fail without having to intervene in some special way just because it's large. Title II of the Dodd-Frank Act establishes a pathway for how to resolve large systemically important financial firms. The Fdic has a plan called a single point of entry, which would allow the bank to be transferred to a new corporate entity. Its outstanding total loss absorbing capital debt would be converted into equity, and so the firm would be recapitalized by its debtors. There's still some work to do on too big to fail. I don't think I would not yet say we've achieved victory. The firms are still working on their resolution plans to make them credible. We still have some work to do on cross-border resolution because it's particularly complicated when a firm has operations in many different countries. But a lot of progress has been made, and I think that we just need to stay on this course. And I think if we do, we can actually say a few years from now that we actually have a situation where we've actually ended too big to fail. The proof of the pudding, of course, will be the next financial crisis. And someone in my position or someone like Treasury Secretary Liu's position, letting that large financial institution fail, and that failure not creating the kind of horrible ripples and shockwaves that we saw in the last crisis, threatening to take down the rest of the system. So the proof of the pudding will only be when we're in that next financial crisis and a large firm gets in trouble, and our willingness to actually let that institution fail, and that failure turning out to be not a catastrophe for the rest of the economy and the financial system. So, hopefully that test is many years off in time. I hope I don't see that in my lifetime, but I completely agree with you. We need to get there. We absolutely need to get there. Thank you very much. I appreciate it very much.
President Dudley, on behalf of VMI, I'd like to thank you again for your speech today and present you with this token of our appreciation.
Thank you.
Thank you.